Let's be honest, dealing with medical expense insurance can feel like you've suddenly been dropped in a foreign country where you don't speak the language.
You're not wrong.
I mean, you've got deductibles and coinsurance and then all these different accounts like HSAs, FSAs. Honestly, it's enough to make anyone's head spin.
Absolutely. There's a lot of jargon to wade through.
Exactly. And that's why we're doing this deep dive. We want to break down this whole world of medical expense insurance and get to the heart of what you really need to know.
We're cutting through the clutter.
Exactly. So we've got all this great material, really in-depth stuff, and we're going to pull out the most important bits, the stuff you really need to get a handle on things.
The essentials.
Right. So we'll be talking about basic versus major medical, those tricky savings accounts, the HSAs and FSAs and all that, and of course, how the Affordable Care Act, the ACA, has shaken things up.
Big time.
So think of this as your crash course in medical expense insurance.
Their cheat sheet.
Exactly. So to kick things off, the material lays out this fundamental difference between basic health insurance policies and major medical expense plans. Now, basic policies seem to offer this first dollar coverage, which sounds pretty good. What's the catch?
Well, first dollar coverage means that the policy starts paying benefits for certain services right away without you having to meet a deductible. So that's definitely appealing.
Right, no upfront costs, at least for those specific services.
Exactly. But the trade-off is that these basic policies tend to have a limited scope. Their benefits are often lower, and there might be time limits or even caps on how many visits they'll cover. So you get some immediate coverage, but it's not a comprehensive solution.
So it's kind of a trade-off then. Immediate coverage, but for fewer things and with lower benefits overall.
Precisely.
Okay, that makes sense. So the material then goes on to break down basic coverage into these three main categories: hospital, surgical, and physician expenses.
Building blocks.
Yeah. So let's start with hospital expense insurance. What exactly does that cover when you're in the hospital?
Basically, it's designed to cover those core costs you rack up when you're admitted to a hospital. Think room and board, the general nursing care, meals, even those basic hygiene items they provide.
The essentials while you're there.
Exactly. And it also covers those other expenses that are directly billed by the hospital. Things like your lab work, x-rays, any medications you get while you're admitted, the cost of intensive care if you need it, operating room use, and all the medical supplies they use.
So it's really focused on the hospital side of the bill.
Precisely. It's about those facility charges.
Okay, so it's all about what the hospital bills. And I see there are two ways these policies might pay out: indemnity and reimbursement. Can you explain how those work for someone actually using the policy?
Sure. With an indemnity policy, you get a fixed dollar amount per day for things like your hospital room.
Regardless of what the hospital actually charges.
Exactly. So say your policy pays out $200 a day, but your room costs $400 a day. You're responsible for covering that difference.
Okay, so it's a set amount. Now, with reimbursement, is that where the policy pays you back for a portion of the actual hospital bill?
Yeah, reimbursement is tied to the actual costs. The policy pays you back a percentage of what the hospital bills, but there's usually a daily limit and a cap on the total number of days they'll cover.
So with indemnity, you know exactly what you're getting, but you might end up paying more if the hospital's charges are high. Whereas with reimbursement, it's based on the real cost, but there could be limits on how much they'll pay back.
Precisely. It's about predictability versus potentially more coverage, but with limitations.
Got it. Fixed amount versus percentage of actual cost, but with potential caps. Now, the material mentions something interesting, that intensive care often gets double coverage.
Yes, that's a common feature. It's because intensive care is usually much more expensive than a standard hospital room, so many policies provide a higher benefit amount for those situations.
That's good to know. But there's a really important point highlighted here. These basic hospital plans mainly cover the hospital's bill, not necessarily the doctors or surgeons involved.
Right, that's a crucial distinction. Healthcare professionals like surgeons, anesthesiologists, or even your regular doctor, they often bill separately for their services.
They're not included in the hospital's bill.
Exactly. So those would typically be covered under a separate basic surgical or physician expense policy, not the hospital plan itself.
So the hospital plan is just for the facility costs, not the actual medical professionals.
Right. It's about the place, not the people providing the care.
Okay, that makes things much clearer. Let's move on to the next category: surgical expense insurance. It seems pretty straightforward. It covers the cost of surgery, right?
Yes. Essentially, it covers those core costs associated with surgery.
But the material says there are different ways these benefits are actually calculated.
That's right. There are a few different approaches.
Can you break those down for us?
Of course. So basic surgical policies cover the surgeon's fees, whether the surgery is done in the hospital or as an outpatient procedure, and they also cover the anesthesiologist's fees and the operating room costs.
Okay, so it's the whole surgical package.
Exactly. Now, the material outlines three main ways these benefits get calculated: the surgical schedule, the relative value scale, and the usual, customary, and reasonable approach.
So starting with the surgical schedule, does that basically mean the insurance company has a list of procedures with a set price for each one?
You got it. It's like a menu of surgeries, each with a predetermined dollar amount attached to it. Simple to understand, but it can get outdated if the actual cost of those procedures go up.
So it's straightforward, but maybe not always the most accurate reflection of current costs.
Right. Now, the relative value scale is a bit more complex.
How so?
Well, instead of having a fixed dollar amount, each type of surgery gets assigned a certain number of units based on how complicated it is and the resources it typically requires.
So a more complex surgery would have more units.
Exactly. Then, the insurance company sets a conversion factor, which is basically a dollar value per unit. So to figure out your benefit, they multiply the number of units for your surgery by that conversion factor.
So it's like a points system for surgeries, and they decide how much each point is worth.
That's a great way to put it. And this system gives the insurance company more flexibility because they can adjust the benefit amounts by tweaking either the unit values or that conversion factor.
Okay, so it's more adaptable to changing costs.
Precisely. More dynamic. Now, the last approach, usual, customary, and reasonable, or UCR, is probably the one you've heard the most.
I think I have. It sounds familiar.
It's super common, especially with more comprehensive health plans. Basically, it means the insurer will pay an amount that they consider usual and customary for that specific procedure in your geographical area.
So it's based on what most doctors in your area charge for that same procedure.
Right. The material says it's often based on the fees charged by, say, 70 to 80% of practitioners in that region. So it's meant to reflect the going rate in your local market.
Okay, that makes sense. But does that mean if my surgeon charges more than what the insurance company considers reasonable, I might have to pay the difference?
That's exactly right. Even if your policy says they'll cover, say, 80% of the UCR cost, if your surgeon's fee is higher than that UCR amount, you'll be on the hook for that extra part, on top of any deductible or coinsurance you might have.
So even though it aims to be fair by reflecting local pricing, it can still lead to some surprise costs if your doctor charges more than what the insurance company thinks is typical.
It's one of those things to be aware of.
Definitely. Now, moving on to physician expense insurance, this one covers those non-surgical services, right?
Exactly. It's for those times when you need to see a doctor, but it's not for a surgical procedure.
Like regular checkups and things like that.
Well, it's more focused on when you're sick or injured. So it covers things like outpatient visits to the doctor's office, visits to the hospital when you're not having surgery, and even house calls in some cases.
So it's for those non-surgical medical services.
Right. And these plans are often paired with those hospital or surgical expense policies we talked about earlier.
Okay, so they work together.
Exactly. And they usually pay a fixed amount per visit for each time you see the doctor for a specific illness or injury.
So it's a set payment per visit.
Yeah. And the material also mentions something called physician assistance policies. These cover services provided by physician assistants, or PAs, when they're working within their scope of practice.
Interesting. So those are the basics. Limited in scope, but often with some upfront coverage for specific types of medical bills.
The foundation.
Exactly. Now let's shift gears and talk about the heavy hitters. Major medical expense plans.
The big leagues.
Right. These sound like they offer much broader protection.
They do. They provide significantly higher maximum benefits, meaning they'll cover more overall, and they have a much wider scope of coverage, all under a single policy.
So one policy for a whole range of potential needs.
Exactly. And these policies typically last for a year. Now, with the Affordable Care Act, many of these plans were designated as providing minimum essential coverage.
So that sets them apart from those less comprehensive plans we sometimes hear about, those skinny plans that might seem cheaper but don't actually cover much.
Right. Major medical is really what most people think of when they picture comprehensive health insurance. It's designed to be that safety net.
So major medical is the kind of plan that covers a wide array of medical situations and treatments.
Yes. The list of benefits is really quite extensive.
Can you give us some examples?
Of course.
Mhm.
The material lists things like regular doctor visits, private duty nursing care if you need it,
Mm.
ambulance services, various therapies, blood and plasma transfusions, oxygen, convalescent care, even home health care services.
So it covers a lot of ground, even beyond the hospital itself.
Right. It also covers prosthetic devices if you need them, and durable medical equipment like wheelchairs or hospital beds for use at home. It's a much broader safety net compared to those basic policies.
It sounds like it. And is it true that these plans often work on an open peril basis? What exactly does that mean?
Open peril is a key feature. It means the policy covers all sorts of medical expenses unless they're specifically excluded in the contract itself.
So basically, everything is covered unless they say it's not.
Right. And that's the opposite of those basic policies, which only cover the specific things they list out.
So major medical casts a much wider net.
Precisely. And just like with those basic plans, major medical often uses that usual, customary, and reasonable standard, the UCR, to decide how much they'll pay for covered services.
So again, it's based on what's typical in your area.
Exactly. And it often ties in with network agreements, meaning you'll likely get the best coverage if you see doctors and hospitals within the plan's network.
So broader coverage and a presumption of coverage unless they state otherwise.
Yeah, that's the general idea.
Now, this is where things get a bit more complicated, right? We need to talk about cost sharing.
The part everyone loves.
Right. So major medical plans typically involve deductibles, coinsurance, and copayments.
The trifecta.
Yeah. So let's break it down. First up, deductibles. The material actually lists several different types of deductibles.
Deductibles can be tricky.
Right. So let's start with the most common one. The calendar year deductible. What's the main idea there?
This one, also called a cumulative or all-cause deductible, is the amount you have to pay out of pocket for covered services within a certain period, usually a calendar year, before the insurance really kicks in and starts paying their share.
So it's the amount you pay before the insurance takes over.
Right. And the key thing is, you only have to meet this deductible once per benefit period. So once you've paid that amount within that year, you're good to go.
Okay, so it resets each year.
Exactly. And there's also this thing called a carryover provision that can be helpful. It basically means that if you haven't hit your full deductible by the last 3 months of the year, any eligible medical expenses you have in those months can be applied towards the next year's deductible.
So if you have big medical bills in November and December, they could help you meet your deductible earlier the following year.
Exactly. It can be in a nice little bonus.
Definitely good for planning. Now, what about a flat deductible? How is that different?
A flat deductible, sometimes called an initial deductible, is a fixed amount that you pay for each specific event, like each time you're admitted to the hospital or each time you go to the emergency room.
So it's not about the total amount over the year, but a set amount for each specific instance.
Precisely. So you might have a flat deductible of $500 for each hospital admission or $250 for each ER visit.
Okay, so it's event specific rather than cumulative.
Exactly.
Then there's this thing called a corridor deductible. This sounds like it comes into play when you have a major medical plan that's working alongside a basic plan.
You're absolutely right. It's like a bridge between those first dollar basic plans and the major medical coverage.
So once your basic plan has paid out all it's going to pay, you hit this corridor deductible.
Right. Once that basic coverage is maxed out, the corridor deductible is what you have to pay before the major medical coverage kicks in. It's filling the gap between the two.
So it's an extra step after the basic, but before the major medical.
Exactly.
Now, an integrated deductible sounds kind of interesting. Does that mean the deductibles from different parts of your coverage can work together?
It does. An integrated deductible is used when you have a policy that combines different types of coverage, like basic and major medical, or when you have multiple health plans that share a single deductible amount.
So instead of having to meet separate deductibles for each part, your payments towards one can count towards the other.
Exactly. And this can really help lower your overall out-of-pocket costs.
The material gives a good example of this, with a major medical plan and a basic plan sharing a deductible. So the payments from the basic plan essentially help you meet that major medical deductible faster.
Right. It's all about coordination.
There's another example with a medical expense policy and a prescription drug plan using an integrated deductible. So instead of potentially having to pay a $500 deductible for each, your payments towards one count towards both.
It streamlines things.
It definitely can save you money.
Absolutely.
Now let's talk about the family deductible. It sounds like this could be a real help for larger families.
It can be. Most policies have an individual deductible, but a family deductible sets a limit on how much the whole family, combined, has to pay in deductibles within a benefit period.
So even if each person hasn't met their individual deductible, once the family as a whole has paid a certain amount, the deductible is met for everyone.
Precisely. And it doesn't matter if one person paid most of it or it was spread out. Once that family total is reached, any further covered expenses for anyone in the family are covered without having to meet more deductible.
The material uses the example of a five-person family where no single person met their full deductible, but the total they paid as a family did reach that family deductible threshold. So from that point on, any covered expenses for anyone in the family are paid without further deductible costs.
That's the benefit. It caps the total deductible burden for the whole family, even if multiple members have healthcare needs.
It sounds like it could make a huge difference.
It can, especially for larger families.
We also have the per cause or occurrence deductible. Does this mean you have to meet a new deductible for each separate health issue you face?
Unfortunately, yes. With a per-cause deductible, you have to meet a new one each time you have a different accident or illness within that policy period.
So if you're in a car accident and then later in the year get pneumonia, you might have to meet two separate deductibles.
That's right. And that can obviously add up quickly if you have multiple unrelated health issues in a year.
Definitely something to keep in mind. Now, lastly, there is the common accident or sickness deductible. This one sounds like it could be helpful for families,
It can be. It's for situations where multiple family members are affected by the same event.
like if everyone gets the flu.
Exactly. Or if several family members are injured in the same car accident. In those cases, only one deductible needs to be met for everyone involved, instead of each person having to meet their own individual deductible.
So it's kind of a safety net for those shared unfortunate events.
Precisely.
That's a lot of different deductibles.
Mhm.
All right, so we've tackled deductibles. Now, what about coinsurance? Is this the percentage of costs you share with the insurance company after you've met your deductible?
That's exactly what it is. It's your share of the bill once that initial deductible is out of the way.
So the insurance pays part and you pay part.
Right. It's usually expressed as a percentage, like 80-20.
80% covered by insurance, 20% by you.
Precisely. So the material has this example. Say you have a $500 deductible and an 80-20 coinsurance. You go to the hospital and have $1,500 in covered expenses.
So you pay the $500 deductible first.
Right. Then you're responsible for 20% of that remaining $1,000, which is $200. So in total, you'd be out of pocket $700 for that hospital visit.
Okay, so it's a way of splitting the cost once you've met that initial deductible hurdle.
Exactly. It's sharing the burden.
Now, what about the stop loss limit or maximum benefit? This is where we start talking about the overall limit on what you'll have to pay in a year, right?
Right. This is a big one. It's now usually called the out-of-pocket maximum, and it's the absolute most you'll have to pay out of pocket for covered services within a single plan year.
So no matter what happens, once you hit that limit, the insurance company covers everything else for the rest of the year. For covered services, yes. But there are a few things that aren't included in that out-of-pocket maximum. It doesn't include your regular monthly premiums, any costs for services that aren't covered by your plan, or any charges from out-of-network providers if your plan doesn't cover them.
So it's a limit on your spending, but only for those covered services within your plan.
Exactly. It's a crucial safeguard, though, because it protects you from getting hit with massive medical bills that you just couldn't afford.
The material goes back to that example of John's $30,000 hospital stay, but this time he has a $5,000 deductible and a 30% coinsurance. It shows how having an out-of-pocket maximum makes a huge difference.
It really does.
It mentions that under the ACA in 2021, that out-of-pocket maximum was $8,550. So even with those high costs, John's out-of-pocket expenses were capped at that amount, right? Without that out-of-pocket maximum, he would have been responsible for a much larger portion of that $30,000 bill. But because of the limit, the insurance company picks up any additional costs for those covered services once he hits that $8,550 cap.
It's a huge protection against potentially devastating medical debt.
Absolutely essential.
Okay, so we've covered deductibles, coinsurance, and the out-of-pocket maximum. Let's touch on a few other important features of major medical plans. The material mentions internal limits or inside limits,
Those are basically limitations on specific types of care within the plan.
like limits on how many days of rehab they'll cover.
Exactly. Or they might only pay for a semi-private hospital room even if you need a private room for medical reasons.
So are these still common in most plans?
Well, the ACA, the Affordable Care Act, has largely done away with these annual internal limits for those services considered essential health benefits.
So for the most part, those important services are no longer subject to these arbitrary limits.
Right. But you might still find them in those less comprehensive plans, those skinny plans that don't fully comply with the ACA.
Okay, so something to watch out for. Now, what about the benefit period? What does that mean?
That's just the length of time your policy will actually pay benefits.
So it could be a year.
Often it's a calendar year, but it could also be tied to a specific event, like the start of an illness or injury, and last for a set amount of time after that. It's just the time frame within which your coverage operates.
Okay, so it's the window of coverage.
Exactly.
Finally, we have pre-existing conditions. This was a huge issue before the ACA, right?
Absolutely. It was a major concern for a lot of people.
So did the ACA essentially fix that problem?
For the most part, yes. The ACA now prevents insurance companies from refusing to cover you or denying benefits based on a health condition you already have.
So you can't be denied coverage just because you have a pre-existing condition.
Right. That's true for most major medical plans now. However, those exclusions might still pop up in short-term medical policies or those less comprehensive skiddy plans we talked about earlier.
So it's not a universal protection, but it's a huge improvement.
It is. Before the ACA, it wasn't uncommon for insurers to charge people with pre-existing conditions higher premiums, or even issue policies that specifically excluded coverage for those conditions using something called an impairment rider.
So your condition was basically written out of the coverage.
Right. And with those non-underwritten policies, there was often a general blanket pre-existing condition exclusion that applied for a certain period after you got the policy.
So it was very difficult for people with pre-existing conditions to get decent coverage.
It was a real struggle for many people.
It's good to know the ACA has addressed this in most major medical plans.
It was a crucial change.
Definitely. So we've covered the basics of how major medical plans work, and we've touched on the impact of the ACA. Now let's talk about the specific laws that govern medical insurance.
The rules of the game.
Right. So we've already mentioned the ACA, the Affordable Care Act. It's obviously had a massive impact.
No doubt about it.
Can you remind us of its main goals and how it's reshaped things?
Sure. The official name is the Patient Protection and Affordable Care Act, and it was enacted with three main objectives: to get more Americans covered by health insurance, make insurance more affordable, and improve the overall quality of healthcare.
Ambitious goals.
They were, and it's had a significant impact on how health insurance works in this country.
We've already touched on some of the big changes, like preventing denials based on pre-existing conditions. What are some of the other ways the ACA has changed the landscape?
Well, it's expanded eligibility for Medicaid in many states, which has helped a lot of people get coverage.
So more people qualify for that safety net.
Exactly. It also introduced subsidies to help people afford those monthly premiums.
So financial assistance to make it more accessible.
Right. And it incentivized businesses to offer health benefits to their employees, which has helped increase coverage rates. Plus, it supported various initiatives focused on making healthcare delivery and research better and more efficient.
So a multi-pronged approach to improving the system.
That's the idea. Now, one of the key creations of the ACA was the health insurance exchanges, also called marketplaces.
These are those online hubs where people can shop for and enroll in health plans.
Exactly. It's like a one-stop shop for comparing different plans and finding the right one for you.
The material talks about their main functions, so they certify plans to make sure they meet certain standards, present the options in a clear and easy-to-compare way, and verify all your information when you apply.
Right. It's designed to be transparent and user-friendly.
No, you can't just enroll any time, right? There's that open enrollment period each year.
That's right. Usually at the end of the year, there's a specific window of time when you can sign up for coverage or make changes to your existing plan.
But what if something major happens outside of that open enrollment period, like you lose your job and your coverage?
That's where special enrollment periods come in. These are triggered by certain life events, what they call qualifying events or changes in status.
So losing coverage from your job would definitely qualify.
Absolutely. Other qualifying events include things like getting married, having a baby, or getting divorced.
So major life changes that impact your coverage needs.
Exactly. And when one of these events happens, You generally have a 60-day window from the date of the event to enroll in or change your coverage through the marketplace.
Okay, so there's some flexibility built in for those situations.
Right. It wouldn't be fair to leave people without options during those times.
Now, the ACA also talks about shared responsibility, which includes that employer shared responsibility payment for larger employers.
That was meant to encourage larger employers to offer health insurance to their workers.
And what about individuals? Is there still a penalty for not having coverage?
Well, at the federal level, the individual mandate penalty has been reduced to zero. But some states have their own rules.
So even though there's no federal penalty, it's always good to check your state's specific requirements.
Absolutely. Some states still have mandates and might impose penalties if you don't have qualifying coverage.
Oh, important to remember. Now, the ACA also introduced those tiered plans, often referred to as metal tiers. Bronze, silver, gold, and platinum. What do those different tiers represent?
They basically categorize plans based on how much they cover on average. They use this thing called actuarial value to do that.
So what's actuarial value?
Think of it as the percentage of total average cost that a plan is expected to pay for those essential health benefits we talked about.
So a higher actuarial value means the plan covers more.
Exactly. Now, bronze plans have the lowest actuarial value, usually around 60%.
So with a bronze plan, you'd likely pay more out of pocket through deductibles, copays, and coinsurance.
Right. You're taking on more of the cost burden with those bronze plans. Now, silver plans are around 70%, gold plans are around 80%, and platinum plans are the highest at around 90%.
So as you move up the tiers, the monthly premiums go up, but you pay less out of pocket when you actually need care.
That's the general trade-off. Lower premiums mean you pay more when you use it, and higher premiums mean you pay less when you use it.
So it's about finding the right balance for your needs and budget.
Exactly. Now, there's a crucial point to remember. No matter which metal tier you choose in the marketplace, they all have the same out-of-pocket maximum.
So there's a limit on your spending, regardless of which tier you pick.
That's right. The ACA put that in as a consumer protection. So whether you go bronze or platinum, there's a cap on how much you'll have to pay out of pocket within a year.
The material mentions that for 2021, the limit was $8,550 for individuals and $17,100 for families.
And those numbers have adjusted slightly since then. But the concept is the same. It's a safety net, no matter what plan you choose.
A very important protection.
Absolutely.
Now, another big change brought about by the ACA was the ability for young adults to stay on their parents' health insurance until age 26.
That's right. This provision has been a lifeline for many young people.
And it doesn't matter if they're married, financially independent, or in school.
It doesn't. They're covered regardless of those factors.
Yeah.
And it includes biological children, adopted children, and stepchildren.
So it covers a wide range of family situations.
It does. And the material mentions that once they hit 26, there might be options for continuing coverage through COBRA, which is a continuation of benefits program.
Okay, so there might be ways to bridge the gap.
Right.
We also can't forget about the essential health benefits.
Yeah.
These are those 10 categories of services that every ACA-compliant major medical plan has to cover.
The core services.
Right, and there can't be any annual or lifetime limits on these benefits, so it sets a basic level of comprehensive coverage that everyone is entitled to.
Exactly. It ensures everyone has access to those fundamental services without arbitrary limits.
What are those 10 categories?
Well, there are ambulatory patient services, meaning those outpatient services you get without being admitted to a hospital. Then there are emergency services, which are pretty self-explanatory.
Of course.
Then we have hospitalization, covering those inpatient services when you're admitted to a hospital.
Okay, so the big three are covered.
Right. And then there's pregnancy, maternity, and newborn care, which is obviously essential for families.
A big one for sure.
And then there's mental health and substance use disorder services, including those behavioral health treatments that are becoming more and more recognized as essential.
Mental health is so important, so it's good to see that covered.
Absolutely. Then there are prescription drugs, which can be a huge expense for many people.
Definitely a necessity for a lot of people.
Right. And then we have rehabilitative and habilitative services and devices, which are those services and tools that help people regain lost function or develop skills they might be missing due to a disability.
So things like physical therapy or occupational therapy.
Exactly. Then there are laboratory services, which cover those diagnostic tests that are often needed to figure out what's going on.
Those can be expensive.
They can. And lastly, there's preventive and wellness services and chronic disease management.
So those regular checkups and screenings that help you stay healthy and manage any ongoing health conditions?
Right. And under pediatric services, it includes basic dental and vision care for kids. But it's important to remember that for adults, dental and vision are typically optional extras that you have to pay an additional premium for.
So not automatically included for adults.
Right.
Speaking of prevention, the ACA also mandated coverage for a bunch of preventive services at no cost to you.
That's right.